Clarify Capital surveyed 1,000 Americans with an average age of 41 and asked them one question. What is your biggest financial mistake? The answers were not surprising, but the numbers behind them are worth sitting with. Because the most common regrets are not exotic mistakes made by careless people. They are the exact decisions that feel reasonable in the moment and reveal their true cost only years later. On average, the Americans surveyed estimated their net worth would be $40,000 higher today if they had avoided their biggest financial mistake. 1 in 3 believed they would have $100,000 more in their accounts. In the next 8 minutes, you are going to understand the 4 most common financial regrets in America, exactly why each one costs more than people realize, and the specific action that addresses each one before it becomes your regret too. This is the Vault Keeper. Let me start with the most important context. A Bankrate financial regret survey found that 77% of U.S. adults have at least one financial regret. That is not a fringe group. That is essentially everyone. And the most common response when people with financial regrets were asked about their progress. 40% had made no progress on their biggest regret over the last 12 months. The regret exists, the awareness exists, the action does not follow. Understanding why that gap between awareness and action exists is as important as understanding what the regrets are. Because the fix for most of these regrets is not complicated, it is specific and executable. The problem is that most people never have the information laid out clearly enough to act on it. Regret 1, not investing earlier in life. This was the single most commonly cited financial regret in the Clarify Capital survey. Not credit card debt, not overspending on a car, not a bad business decision, simply not starting to invest sooner. The math behind this regret is one of the most straightforward in personal finance. A person who invests $300 per month starting at age 25 in a low-cost index fund earning 7% annually will have approximately $815,000 by age 65. The same person starting at 35 with the same $300 per month at the same return will have approximately $379,000. The 10-year delay costs $436,000 in final wealth. Not from additional contributions. The 10-year Head Start accounts for only $36,000 in extra contributions. The $436,000 difference comes from compound interest having 10 more years to work. That is the mathematical foundation of this regret. The people who said they wished they had started investing earlier are not describing a mistake that required genius or sophistication to avoid. They are describing the straightforward cost of waiting, of putting it off until things settled down, of waiting until there was more room in the budget, of waiting until they understood the market better, and each year of waiting had a permanently compounding cost. Americans' biggest financial regrets were not investing earlier in life, overspending, and taking on too much debt. On average, they estimated their net worth would be $40,000 higher today if they had avoided their biggest financial mistake, while 1 in 3 believed they would have $100,000 more in their accounts. CNN. The fix for this regret, if it is not already your past, is the most time-sensitive of all 5. The value of starting today versus starting in 1 year is not $3,600 in contributions. It is $3,600 plus all the compound growth that $3,600 generates for the next 30 years. At 7% annually, $3,600 invested today becomes approximately $27,000 over 30 years. Every year of delay has that permanently compounding cost. The practical action: open a Roth IRA today if you do not have one. The 2026 contribution limit is $7,500. Set up an automatic monthly contribution of whatever amount you can sustain. Even $100 per month starts the compounding clock. If your employer offers a 401k with a match, contribute at least enough to capture the full match before doing anything else. That matches a guaranteed 50% to 100% return on day one, the highest guaranteed return available in personal finance. Regret 2. Not saving enough for retirement and for emergencies. According to a Bankrate financial regret survey, 22% of Americans say their biggest financial regret is not saving for retirement early enough. An Intuit Credit Karma survey found that not saving enough was the most common money regret in 2025, cited by 38% of respondents. And a NerdWallet survey found that not saving for emergencies was the top regret for 29% of Americans. These are two distinct savings failures that often compound each other. The household without an emergency fund is forced to dip into retirement savings when an unexpected expense hits. That withdrawal does not just remove the principal, it triggers taxes, potential early withdrawal penalties, and eliminates all the future compounding that money would have generated. Every emergency withdrawal from a retirement account is a double punishment. The immediate financial cost of the emergency plus the permanent compounding cost of the withdrawn funds. Around 19% of Americans have no savings at all, while the majority have less than $500 in a savings account, according to a 2025 Go Banking Rate survey. That means most American households are one unexpected expense away from either borrowing at high interest or raiding their retirement savings. Both options are expensive, both options are avoidable. The fix has a specific sequence. Before maximizing retirement contributions, before optimizing your 401k, build a $1,000 starter emergency fund. That single step eliminates the most expensive emergency debt scenarios. Then capture your full employer 401k match. Then build the emergency fund to 3 months of essential expenses. Then maximize your Roth IRA. The sequence matters because the $1,000 emergency fund protects your retirement savings from being raided the next time something unexpected happens. Regret 3. Taking on too much credit card debt. Nearly 1 in 4 Americans regret charging too much on credit cards. Of those who regret charging too much, 11% carry balances of $30,000 to $50,000, while 22% owe between $15,001 and $30,000. J.P. Morgan. The credit card regret is uniquely painful because it is self-reinforcing. The household that carries a credit card balance at 20% APR is paying approximately $1,500 per year in interest on a $7,500 balance. That $1,500 per year in interest is money that cannot go toward building the emergency fund, cannot go toward retirement contributions, and cannot go toward any other financial goal. The debt does not just cost you in interest. It costs you in all the financial progress you cannot make because the cash flow is going to the credit card company instead. Many admitted they underestimated how quickly small purchases could balloon into overwhelming balances and how long it took to get out of debt. CNBC. That underestimation is the core of the credit card regret. A $50 dinner feels like $50 in the moment. Put on a credit card that is not paid off. It becomes a $50 dinner that costs $57 after interest if it takes 7 months to pay off. Multiplied across hundreds of purchases over months and years, the gap between what things cost and what they actually end up costing through credit card interest is where the regret lives. The fix is the debt avalanche. List every debt from highest interest rate to lowest. Make minimum payments on everything to protect your credit score. Put every additional dollar toward the highest rate debt first. The guaranteed return on every dollar applied to 20% credit card debt is 20%. That return is higher than any investment available to ordinary Americans today. Paying off credit card debt is investing at a guaranteed 20% return. Regret 4. Buying cars they could not afford. This was the third most common regret in the Newsweek survey, and it is one of the most financially damaging because it operates through several simultaneous mechanisms that most people never calculate together. A car is a depreciating asset. From the moment you drive it off the lot, it loses value. The average new car loses approximately 20% of its value in the first year, and between 15% and 25% per year in years 2 and 3. A $45,000 car purchased today will be worth approximately $27,000 in 3 years. That $18,000 in depreciation is a cost you are paying regardless of whether you notice it. Layer a car loan on top of that depreciation. The average new car loan in 2026 carries an interest rate of approximately 7.5% and an average loan amount of approximately $40,000. Over a 72-month term, the most common loan length, the total interest paid is approximately $10,000. So the $40,000 car actually costs $50,000 in cash outflows, plus loses $18,000 to $20,000 in value over 3 years. The total real cost of that $40,000 car decision over 3 years is approximately $28,000 to $30,000. Nearly 70% of the original purchase price absorbed in 3 years through a combination of interest and depreciation. And while all of this is happening, the car payment, often $600 to $800 per month for a new vehicle, is consuming cash flow that could be going toward the emergency fund, toward credit card debt payoff, toward retirement contributions. Car payments are one of the most effective ways to prevent other financial progress from happening. The financially optimal car decision for most American households is a 3 to 5-year-old used vehicle purchased either outright or with the shortest loan term possible. A 3-year-old car that originally cost $40,000 can often be purchased for $24,000 to $28,000. The major depreciation has already occurred. The vehicle still has significant useful life remaining, and the monthly payment, or the absence of a monthly payment if purchased outright, frees significant cash flow for higher priority financial goals. Regret 5. Not having a written financial plan. This one does not show up in most financial regret surveys because people do not frame it as a regret. They frame it as the other regrets. Not saving enough, too much debt, not investing early enough. But the root cause underneath all of those regrets is often the same: the absence of a specific written plan with concrete numbers and automated systems. 2 in 5 people with a financial regret have not made any progress on their regret over the last 12 months. The biggest reason? Nearly half say inflation and high prices negatively influence their progress. J.P. Morgan. But here is the honest data point behind that finding. Inflation was also present for the households that did make progress on their financial regrets. The difference is not the external environment. The difference is whether there is a specific written plan with automated contributions and a monthly measurement of progress. A Transamerica National Survey found that fewer than 1 in 4 Americans, just 23%, currently maintain a written retirement plan. The households with a written plan report significantly greater confidence, are more likely to save consistently, and are more likely to have made progress on their financial goals in the previous 12 months, regardless of economic conditions. A written financial plan does not need to be complex. It needs 4 specific elements: a current net worth calculation, total assets minus total liabilities, a monthly budget framework that explicitly allocates a percentage of income to financial goals before discretionary spending, a specific retirement savings target with a contribution rate that reaches it, and automated transfers that move money to savings and investment accounts on payday before discretionary spending is possible. The households that regret their financial decisions are not unintelligent or undisciplined. They are households that face the same financial decisions as everyone else without a framework for making them consistently well. The framework is what changes outcomes. Not willpower, not income, not luck. Here is your complete action plan based on the 4 most common American financial regrets. First, start investing today regardless of the amount. Even $50 per month in a Roth IRA starts the compounding clock that delay permanently costs. The best time was 10 years ago. The second best time is today. Second, build a $1,000 emergency fund before maximizing retirement contributions. This protects your retirement savings from being raided every time something unexpected happens. Third, apply the debt avalanche to any credit card debt you carry. Highest interest rate first. Every dollar applied to 20% credit card debt generates a guaranteed 20% return, higher than any investment available today. Fourth, before your next vehicle purchase, calculate the full 3-year cost, purchase price, plus interest, plus depreciation. Compare that number to a 3 to 5-year-old used vehicle purchased for cash or with the shortest possible loan. The difference in cash flow over 3 years often exceeds $15,000. Fifth, write down your current net worth, your monthly budget allocation, and your retirement savings target. Automate contributions on payday. Measure progress monthly. The written plan is the mechanism that converts awareness into action. The 77% of Americans with financial regrets are not defined by those regrets. They are defined by what they choose to do with the awareness that comes from having them. Drop a comment below. What is your biggest financial regret? You are not alone. I read every comment and respond to every question directly. Tell us what state you are watching from. Subscribe to the Vault Keeper newsletter for daily financial intelligence before markets open. Every morning before the session starts, you get the information that matters in plain language with clear implications for your financial decisions. Link is in the description below. Subscribe, turn on notifications, data before price. The Vault Keeper.